Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here, your host for this week with my friend and colleague, Lawrence Gillum. Lawrence, the bond market's been quite interesting these days with yields going up, so I'm hoping you are going to explain to me why that's happening after the Fed cut rates. And, I guess there's really nothing election related yet to push yields up. So you're going to help us explain that, right?
I will do my best. It's been an interesting couple of weeks post Fed meeting. But remember, as a bond market guy, I don't like interesting. I'm more of the boring sort. But I think I have some answers for you.
Very good. Well, I look forward to those. If the bond content is not interesting enough, then we will have to try to spice things up with some discussions of earnings season. Those are our two main topics today. Here's your agenda. Start, of course, with a recap of last week where stocks went up again. Actually, bonds went up a little bit too. Then we'll talk about earnings season, more about the outlook for the quarter and next year than an update on what we've already heard so far, which is not much. But certainly earnings season, a big story this week. Next, we'll hear from Lawrence and how he would explain this latest move up in yields, which my guess is some of you did not expect. Maybe many of you did not expect. And then we'll finish it up with the week ahead, where I'm calling it less is more, less economic data, more earnings. So let's get to it here. Starting off with the recap. First, you got to start with the fact that we are up 6 straight weeks, not just for the S&P, but for the Dow and the NASDAQ as well. If you ask yourself why, I would argue that the primary reason is the soft landing narrative is really gaining steam. Some might argue that the slight increase in the odds of a Republican sweep are helping stocks because the market might be pricing in a greater chance of more tax cuts. Certainly hard to prove that, but that may be a little bit of this too. And then before the move in yields today, at least yields were pretty stable last week. So those were the things I'd highlight. S&P 500 up almost 1%. The leadership, certainly you had technology kind of hanging in there, doing okay, in line. But the interest rate sensitives led the way, which is a little bit surprising. I think real estate up 3, utilities up 3.5, roughly. Some of that is AI related because utilities are getting a lift from AI power demand. But I think probably the anticipation of more rate cuts and the at least stability in yields last week possibly at play there. It does not appear that this is a market move toward defensives to protect. I mean, that might be some of it, but the economy is just doing too well. Retail sales last week very strong. That was the latest piece of evidence that this economy is going along just fine. So moving on. So Lawrence, the bond market. I mean, I said it was up. It's not up much, 0.1%. What worked and what didn't last week?
Yeah, so it was a muted week. I'll say last week, ag up about 10 basis points. Remember, it was a holiday shortened week, so only 4 days there to perform. Good after point. The Columbus Day Indigenous People holiday on Monday. But we did see kind of flattish yields, I'll say, over the course of the past week. Treasury's up about 10 basis points. Mortgage is underperformed by about 10 basis points there as well. That's an area that we continue to like, to think valuations are attractive. The repricing last week in yields maybe offset some of the good news in the mortgage market with regard to valuations, but we still think that that's an attractive asset class. What worked last week was credit, and high yield credit in particular, up 40 basis points. High yield munis up 30 basis points, quietly up over 18% over the past 12 months for muni high yield bonds. Lastly, preferreds up 40 basis points, up 23% over the past 12 months. Regular listeners know that we recently downgraded our view on preferred slightly, given valuations. We think preferreds are still attractive, not as attractive as they were about a year ago, given the 23% returns out of that market. But we still think there's a lot of value in that market. But as you mentioned, kind of a muted week last week. This week is not starting out great, given the backup in yields that we've seen, which we'll talk more about over the next 30 minutes or so. But it was I'll call it an okay week, given what we're about to talk about. A little teaser there for the fixed income segment.
Yeah, I think commodities were really interesting last week because look at the natural gas drop almost 10%, crude oil down a little over 6%. The reason for that, it seems, was the news that Iran, or that Israel was not going to strike Iran's oil producing assets. That could still happen, but certainly it appears unlikely. At this point, we're still seeing escalation, no doubt, in the fighting over there, but it looks like it's more likely than not that the oil production will continue largely unaffected. The other thing that's interesting in the commodity space is precious metals. I mean, look at the move in silver last week, up 8%. Gold up almost 3%. Gold is at a new all-time high. That might be partly geopolitical, might be partly related to the market saying that rates will come down eventually, the dollar will come down eventually. I think that's mostly consensus, but it just hasn't happened yet. So we'll call it a pretty resilient performance for precious metals, despite the fact that the dollar really isn't helping, and at least in the last few weeks, I don't think rates have been helping either. You see here in the bottom right-hand panel, the dollar up 0.2% for the 5-day. It's actually been up over the last month, even though it's not obvious based on the time frames that are showing here. So that's certainly a key area to watch. A stronger dollar, market sees it as a safe haven, and if it's strong enough, it can affect earnings negatively, and it can also tighten financial conditions, as Lawrence, you certainly know all too well. So the S&P 500 just keeps going up. The LPL research team is sticking with the neutral stance on equities, and it's really mostly about technical analysis because valuations are high. I mean, the fundamentals are certainly supportive in general, but you could argue that election uncertainty and geopolitics maybe offset the strength in the economy and in earnings, and maybe you give financial or fundamentals kind of a neutral score. So it really just comes down to technicals. The momentum of this market is so strong, it's not even overbought yet. The RSI 14, Relative Strength Index, on a 14-day trailing basis is not yet over 70. And that is the trigger when an index becomes overbought. We're not even there yet. I think the 10-year yield is overbought. That's certainly a little bit of a different story. And we're also not seeing the components all that overbought either. You see that on the bottom panel in red. That red line up to 14% is nowhere near some of the highs of the past year. So you have an index that's not quite overbought, and you have a lot of constituents that are not yet overbought. So we think there's probably a little bit more upside from a technical perspective. Let's turn to earnings now. This is the topic of our weekly market commentary for this week. I think the headline is expectations. The bar is low, right, for Q3, and the growth rate won't be very good in Q3. But expectations are for a really nice acceleration in Q4 and beyond. Those expectations might be too high, but we still think we're going to get a pretty nice earnings acceleration over the next year. And this is really an important piece of the bull case, right? This market's doing very, very well. The economy, we know, is doing very well, certainly better than most people expected. You add on top of that the potential for double-digit earnings growth over the next year, and there could even be a little bit more upside to stocks. Not necessarily our base case. We still think this market is maybe worth something around 5,500 on the S&P, even though we're already over 5,800 right now. But if this market's going to keep going, it's going to be earnings driven. These expectations are too high, but analysts' expectations are pretty much always too high. So that in and of itself, if estimates come down, is not a reason for concern. This is the first quarter where we're really seeing the gap close between the Mag 7 earnings growth and the rest of the market. It's still fairly wide. We're still talking about roughly 20% earnings growth for the Mag 7 and marginal earnings growth for the rest of the market. But at least we've gotten closer, and then over the next several quarters, we'll probably get a little bit closer. And, we'll see double-digit earnings growth out of the rest of the market, while the Mag 7 potentially continues to grow in the, call it, mid to high teens. So that narrowing gap between Mag 7 and the rest of the market should help support value, and it should help the equal weight S&P 500 do better relative to the market cap. So that's something that we continue to watch. The operating margins are about to take a nice uptick. Now, here again, just like with earnings estimates, we think margin estimates are probably too high. But you look at this chart, the arrow really starts going up in the first half of 2024. We'll hopefully see these numbers actually come through. Now they're just estimates. But companies are actually in pretty good shape. They're controlling costs well. As inflation comes down, you're actually seeing the consumer price index rise faster than the producer price index, wholesale prices. And that widening gap, it's kind of minimal, but that widening gap is helping support margins. And we expect them to go higher, just maybe not quite as high as these consensus estimates reflect. And then lastly, and then I'll hand it over to you, Lawrence, for any thoughts you have on earnings. It's certainly supporting corporate credit because balance sheets are in such good shape and companies are growing earnings nicely. Here are the estimates. The key number to watch is that 275 for consensus 2025. If that only goes down a buck or two, that's a win. Stocks should do well. If that goes down $5 or more, then the market might have a little bit of a tough time justifying current valuations. We're at 22 times forward earnings. So you really need those earnings to come through to support these valuations. Now, the fact that stocks have been expensive for the past several years hasn't mattered, right? We're up something like 63% in this bull market, a little over 2 years old. At some point, it'll matter. And, it's up to earnings to maybe delay that. I hate to call it a reckoning because that's a little too strong, but delay that pullback in the market that really, tells investors that we've gone a little bit over our skis. What do you think, Lawrence?
No, I think you're absolutely right. I was going to mention spreads as well, and we talked about corporate credit doing well this year, and certainly the better economic conditions are helping keep corporate spreads tight. But the earnings season is also allowing these credit spreads to remain tight. What's been interesting is that you really haven't seen any sort of big widening of spreads at the individual bond level either. Even if a company misses earnings expectations, it's been one of those things where there's such demand for corporate credit. I would even argue that even if earnings season doesn't end up well, you're likely going to continue to see tight spreads. So I think there's just that much demand. But certainly the earnings environment is helping justify spreads at secularly tight levels as they are currently.
Yeah, really the only weak spot in earnings right now is the energy sector. So it's possible that you would see a little bit of wider spreads maybe in the lower market cap energy names. I mean, other than that, it's pretty broad. Well, Boeing too. Boeing by itself is potentially going to be near a 1-point drag on S&P 500 earnings. But outside of that, even industrials are probably going to grow earnings. And that's one of the slowest growers right now. We still like that sector and it's doing quite well, but you're not seeing the earnings growth quite come through in Q3. It'd probably start coming through in Q4. So any thoughts on on energy or potential risk from Boeing?
Well, yeah, Boeing has been a laggard in the fixed income markets. There's been a lot of talk about Boeing getting downgraded. It's not so we have a corporate credit focus list. It's not on that list, thankfully, which it wouldn't be on there anyway, given our quality screens. But yeah, that's a name to certainly avoid in the fixed income markets. Energy, I mean, spreads haven't really done much there, other than stay secularly tight as well as the rest of the corporate
Wow.
credit universe. So, like I said, I think we talk about corporate credit spreads leading as a leading indicator. Spreads are tight, and they're at levels which would suggest that everything is hunky dory in the world, and maybe that it's a bit too optimistic on the corporate credit side, but it's not flashing any sort of red warning signals or any sort of red flags at this point. So we'll keep watching, but I mean the corporate credit markets are surprisingly and extremely resilient despite everything that's going on in the world right now.
Yeah, that's amazing. I mean, because you can understand why, um, you know, Israel attacks, Hezbollah attacks, Hamas attacks, all of that. You can understand why that wouldn't affect corporate profits in the U.S. Actually, it helps corporate profits, right? Because it helps energy companies maybe make a little more on selling oil, and then it also supports defense spending. So that's not really an earnings driver, which is important to keep in mind. But what is an earnings driver is the energy sector, losing, let's call it 17% of its earnings year over year. If that's not affecting credit markets, then that really underscores the resilience of S&P 500 profits. So good earnings picture. Again, we're not going to have a great headline earnings growth number. The consensus is around 3, so maybe you get to 5, maybe 6, something like that. Ex Boeing anyway. That's a deceleration. It's really a lot of comparisons from the prior year, kind of creating that tougher base to grow off of this quarter. So don't think about this as a 3% earnings growth environment. Think of it as, high single digits, maybe low double digits. We're going to get right back to that. It appears in Q4. So that's kind of a high level take on what to expect for earnings season. We are going to get 112 S&P 500 companies this week, so it's a very busy week. The banks got us off to a good start. We got some pretty good commentary around net interest margins, which is a key element of bank profits, the difference between borrowing costs and lending revenue, essentially. And then capital markets actually were pretty good. Things like bond underwriting, Lawrence, your world, even general investment banking and equity trading were a little better, I think, than the market expected. And you ended up with a pretty good start. I think the average upside surprise for banks was 6%. That's really most of what we've gotten so far. So it'll be interesting to see what we get this week as we broaden out. So let's turn to bond market, Lawrence. Here you kind of answer the question we teed up at the front, which is, why are yields going up, right? The Fed just cut 50 basis points. They're going to cut more. Inflation's coming down, and yet rates go up. I think here's your answer right here on the title slide.
Yeah. I've done a couple advisor events here in the past couple of weeks, client events in the past couple of weeks, and I would say that the question that is routinely asked is that very question about why are Treasury yields higher after the Fed cut rates. And if you look at this chart here, this is a chart of the 10-year Treasury yield. If you look around that September time period, that the low actually happened on September 16th. So the Fed cut rates 50 basis points 2 days later, and yields are about, call it 0.5% higher since those September 16th lows. So it has been a bit perplexing, after enduring one of the worst, or actually the worst calendar year for fixed income back in 2022. Given the rate hiking cycle that took place back then, investors thought perhaps that rate cutting cycle would be an easy one and a positive one for fixed income investors. It hasn't happened yet. And the reason why it hasn't happened yet, if you want to go to the next slide, is it's just that we've seen better economic data than what economists and what markets were expecting. So this is kind of a messy chart here, but the blue line represents the Bloomberg U.S. Economic Surprise Index. That takes into consideration things that are impactful to economic growth. You have payrolls, you have retail sales, you have a lot of kind of growth metrics in there. And since around the August timeframe, that economic data has been coming in better than what economists had expected. Now, you can interpret this as saying that economists have been wrong, or markets have, or the economy has been better than expected. Probably some of both, given the difficulty in trying to read this economy. But nonetheless, the economic data has been coming in better. If you look at the last jobs report we got back in, when was that? It was last month, with over 250,000 jobs were created, significantly outpacing expectations. Jeff, you mentioned retail sales too, coming in better than expected last week. So the trajectory has been an economy that seems to be kind of, I hate to say expected again, but better than expected. So in that environment, Treasury yields tend to trend higher, and that's exactly what we've seen. And the reason why Treasury yields are trending higher is because the next slide, it will show you that we continue to get rate cut expectations priced out. So if you think about what markets were expecting in terms of rate cuts, markets had a pretty aggressive rate cutting cycle priced in already, even before the meeting. Markets were expecting the Fed to cut rates 8 times before the Fed even cut rates once. So the markets were trying to front run the Fed once again. And that's that blue line there. Markets had a 2.87% kind of neutral rates. And as a neutral rate, remember, that's an interest rate that's neither accommodative nor restrictive. It's just the rate that doesn't influence economic activity. But markets were thinking that the Fed was going to take that Fed funds rate from 5.5% down to around 2.87% this rate cutting cycle. Whereas that better economic data has pushed that terminal rate higher. It's around 3.4% now. So that has in turn pushed Treasury yields higher as well. So really what the market is saying is that given the better economic data, there isn't as much need for an aggressive rate cutting cycle at this point. Now that can change if we get softer data, particularly softer labor market data. But as we sit here today on October 21st, it's the economy seems to be in pretty good position, and absent any sort of economic slowdown, we tend to get higher Treasury yields, in an environment that continues to perform well. So that's really been the reason. You could also argue, though, that, as you mentioned earlier too, Jeff, that the prospects of perhaps a red wave or a Republican sweep in the election could start to matter a bit more. I was actually talking to media today about this, that the Treasury Department released its 2024 fiscal year information. Budget deficits were 1.8 trillion. The expectation is those budget deficits are going to continue to grow regardless of who wins the presidency. But if you do have a sweep, either a Democratic sweep or a Republican sweep, meaning either party controls the White House as well as both chambers of Congress, that means spending will likely continue unabated, which means higher deficits, which means higher Treasury issuance. So we're going to write about this tomorrow, but that Treasury term premium, which is it's a theoretical construct, but it kind of tries to price in the expected or the required compensation for owning longer maturity securities. That has started to trend higher. It's positive now, so investors may start demanding more compensation for owning longer maturity securities. And with the amount of Treasury debt coming to market over the next decade or so, we could continue to see that term premium pushed higher. But bottom line is better economic data, more government spending, more Treasury issuance. It's been a rough place to be invested right now, and particularly in the long end of the Treasury curve, given all the things we just talked about. But Yeah, it's not gone according to history, right? So normally when the Fed starts cutting rates, Treasury yields fall as well, but that has not been the case this year.
Yeah, I also understand that rates tend to move higher post-election. So, it's as we say with every study we do around the election, there's a small sample size. But I wonder if a little bit of this move is not just related to prospects for Trump to win and for deficit spending, but just for prospects for the election to potentially be over,
Right.
and the market may be front running the clarity that comes regardless of who wins after November 5th.
Yeah, so we released that election piece not too long ago, and the bond market does provide a safe haven space in terms of that policy uncertainty. So we do tend to see yields fall, bonds, particularly high quality bonds, do well in an environment where policy uncertainty is high. I guess as the election gets closer, there's more certainty with potentially more certainty with the outcome. We have historically seen bond yields move higher in that environment as well. So it's a confluence of events, but it hasn't really been an easy narrative for a lot of investors that kind of went through 2022 in that aggressive rate hiking campaign, and to see yields move higher as the Fed starts to cut rates, I think is a bit perplexing to a lot of individuals out there.
Yeah, I mean, I guess what's clearest is that a solid economy is putting some upward pressure on yields. We know that for sure. Some of these other factors, election, deficit spending, Fed positioning, over time that probably won't matter as much as economic growth and of course inflation, right? You put those two pieces together, and that's going to explain a lot of where the bond market is. Is that fair?
Yeah, it is. And we'll see. I mean, there was a lot of discussion going into that Fed meeting about 25 basis point cut, 50 basis point cut. I think it's too early to tell if it was an error or not on the behalf of the Fed by cutting 50 basis points and not 25 basis points. We have seen market implied inflation expectations creep higher as well. If that continues, I think you could probably say that 50 basis point cut may have been an error, but we'll have to see how this plays out. But it was pretty remarkable what was priced into markets right before the Fed meeting. I mean, we've talked about this in our strategic and tactical asset allocation committee meeting. What was priced into markets this time around was a lot more aggressive than a typical rate cutting cycle would normally be priced in right now. So I think I've mentioned this each time I've been on the podcast. The bond market continues to try to front run Fed activity, only to get pushed back when the economic data continues to come in better than expected.
Yep, over and over again. At the start of the year, we were at 6 cuts for this year, and we, might get 3, I guess, or 4, if you count the 50 as 2. And maybe the 50 was a mistake, but if they'd broken it up into 225s and maybe been more hawkish with their language, maybe they would have kept rate cut expectations in check. I mean, it's
Yeah,
always
it's
hard to
easy to
know.
be a Monday morning quarterback, but the Fed's job is not easy. It's not something that I mean, they're damned if they do, damned if they don't. So um, I that's not a job I would ever want to have as the head of the Federal Reserve, because it's really a no-win position.
Yeah, Powell may not want to have it either after he finishes up his current term. So, of course, he may not be reappointed. We won't get into that right now, but that is a fun discussion for another day. So, back to the bond market, we're still sticking with our 375 to 425 forecast for the 10-year Treasury yield at year end, right, Lawrence?
We are, yep. So we're at around 418 right now. So we got 2 months left in the year. So I think we are going to really kind of stay in this 375, 425 range throughout the rest of this year. I mean, we could get above that by a couple of basis points or below it by a couple of basis points, but I kind of think we're around these levels to end the year.
Yeah, we'll still eventually have an economic slowdown, but there's very little evidence that it's coming anytime soon. So thanks for the thoughts on the bond market, Lawrence. Let's move to the week ahead, where, as I mentioned, it's over 100 earnings reports from S&P 500 companies. So that is going to get by far and away the most attention from investors, unless something certainly meaningful comes out of the Middle East. There is some economic data on the calendar. The Beige book, I think, will be interesting. Again, we're just looking for evidence that this economy is slowing. Sure, the job market has slowed a little bit, that last report aside. And, you have seen some other pieces of evidence that the U.S. economy slowed a little bit, but really not much. So I don't think you're getting anything dramatic from the Beige book, just a report of the economic activity from all of the districts across the country. It's more of a Main Street type of report. So we'll look through that and see what is interesting. But other than that, I mean, claims is always interesting when you're you think you're moving more toward a late cycle economy. Plus, we had the hurricanes distort those numbers the prior week, so we'll be interested in seeing what happens there. Otherwise, I just don't think there's that much interesting. So, Lawrence, how about on your side, anything interesting coming out of the Fed this week? Treasury auctions or any of this data you think worth highlighting?
No, it's supposed to be I may jinx myself here, but it's supposed to be a quiet week for economic data, for Fed data. No real Treasury auctions to speak of. There's a 20-year auction later this week, but other than that, it really is kind of a quiet week. But I think the point you made earlier too is that the economic data, given the strikes and the hurricane data, it might start to get messy, lack of a better term there, as we get further along into this calendar of economic data. But so we'll have to see how this data comes out and if there's revisions necessary. But other than that, it should be a quiet week. I'm knocking on wood here, as if I don't know if you can hear me that or not, but we'll see.
I don't hear the knocking, but I'll take your word for it. Certainly, I'm interested to hear what companies have to say about the earnings environment. Tesla's the only Mag 7 this week, I believe. Boeing will be interesting, certainly, given their challenges. And, otherwise it's just a variety of kind of blue chip names, your IBMs, your Texas Instruments, your Johnson and Johnsons of the world, right? But I think will give us a good picture after you get through a quarter of the companies having reported. You really have a good sense for the environment. So this will be an important week. And, as we're recording this on Monday, we do have a little bit of red on our screens. Hopefully we'll get some good news out of corporate America that can help lift this market. As I said, I think the earnings picture is probably the number one most important thing if this market is going to go higher. Certainly, again, you could argue that the potential for more tax cuts under a Trump administration would be important too, but we won't know that, obviously, for at least a couple of weeks. So with that, we'll go ahead and close. Thanks so much, Lawrence, for your thoughts on the bond market. I really do find yields interesting, even though I'm an equity guy. It's just a fascinating environment. There are a lot of countervailing forces, and there's a lot of narratives people are trying for, and they don't all fit perfectly, which just makes it interesting, telling stories about the market and trying to figure out where it's going to go. And certainly earnings are interesting as well. So thanks everybody for listening to another LPL Market Signals. We appreciate your support. We will see you next time. Have a great week, everybody, and take care.